Hello, and welcome to the No Bad Questions podcast, where I try to learn in a conversational manner, to break down jargon, and to present the least amount of filtering as possible on a wide array of topics. I hope that you learn something too. If you do and want to support the podcast, you probably already know all the ways that you can do so. You can like, share, subscribe, hit the notifications, but ultimately, and what I hope you choose to do, is watch to the very end. With that, we'll start today's podcast. Welcome, everyone, to this week's episode of the No Bad Questions podcast. My guest today is Matthew T. Simon. Since 2006, Matt has been a licensed insurance advisor with CoverLink Insurance, an industry-leading independent insurance agency headquartered in Ohio. Prior to joining the team at CoverLink, he worked as an underwriter with a regional insurance company based in Columbus, Ohio. Matt is a certified insurance counselor and a chartered property and casualty underwriter, having successfully completed the rigorous coursework and exams to earn these prestigious designations. He's the president at CoverLink, serves on the board for the Ohio Insurance Agents Association. He's a state director for the Associated Risk Managers of Ohio, and he's an advisor to the insurtech startup Bold Penguin. In 2013, Matt was awarded and recognized as the National Young Insurance Agent of the Year. In 2017, he received the Excellence in Leadership Award from the Ohio Insurance Agents Association and was recognized as the Insurance Advisor of the Year in 2019 by Finance Monthly. And together today, Matt and I are going to try to make insurance interesting for you. So thank you, Matt, for being here. I appreciate it.
You got it.
So I think most people, including myself, know what insurance is, but what is insurance?
Yeah, it's a great question, right? So everybody thinks of insurance as being fairly straightforward. It's something that most people have to have, but nobody really ever stops to think about what precisely insurance actually does or what the fundamental of insurance is. And at the end of the day, it's really pretty straightforward. Insurance is nothing more than just a risk transfer mechanism. So for consumers, whether that's individuals, families, businesses, they pay a premium, right? They take money out of their pocket and hand it over to another entity, usually an insurance company, to transfer their risk. So really all they're doing is they're saying, hey, for a fixed amount, for a known dollar amount, I want to transfer the unknown portion of what it is that I could be hit with, whether that's my car is totaled, my house burns to the ground, my business is sued. I'm transferring the unknown risk that I may incur in the future for this known premium today. And insurance really only works whenever there is a huge pool of individuals or families or businesses that all kind of have that same mentality, right? So from an insurance company's perspective, they've got to be able to take on that risk from a lot of people or a lot of businesses, basically that pool of buyers, knowing that only a small fraction of those are actually going to incur a loss, right? Because you think about the premium you pay, whether it's your car insurance or your homeowner's insurance, it's generally substantially less than what the actual claim amount ends up being if you have a bad claim. So the only way it works is if we're able to pool all these buyers together that are exchanging a small portion of premium or money, their dollars, for an unknown risk that they may be faced with in the future.
So the idea, let's take an extreme example just to try to make it colorful. So everybody, well, let me rephrase that. Nobody wants to get hit by lightning. And if you get hit by lightning, your organs are fried and whatever. So if I want to go out and get lightning insurance, the odds of that are pretty low. So I'm probably not going to have some huge catastrophic premium that's going to ruin my monthly bills or my monthly budget. But for the insurance company to handle that, they need a lot of people to buy lightning insurance is essentially what you're saying. So even if they charge everybody $1, they need a lot of dollars then, because on the chance that somebody does get struck by lightning, the payout's going to be really expensive. Somebody's life just got ruined because they got, I'm assuming, I don't know, I've never been hit by lightning, but you're going to have so much that happens to your body from all that electricity. Your life is going to be ruined, and so you're going to have a lot of medical bills. Maybe you can't work anymore. All this stuff. So that's the idea: is you got to really spread it out over just tons and tons of people. Am I summarizing correctly?
You are 100% accurate, right? So that really is kind of the fundamental, or I should say, foundation of insurance. So you take that piece of it away, and for the most part, the insurance mechanism collapses. And so your example is right on. Let me give you another example kind of on the other end of that spectrum. So where insurance has kind of collapsed and is not working as well as what it should. So if you think about it, everybody has that exposure, right? You could be struck by lightning, or someone's house could be struck by lightning. What's the unknown is who it's going to hit, right? So everybody buys that insurance policy in your example because nobody really knows who it is that's going to be impacted. But if you take a group of 100 homes or 1,000 or more than likely, hundreds of thousands of homes, and any given year, a certain statistically known percentage of those are going to be hit by lightning and therefore are going to have a claim. Right. So here's the example of where it breaks down is flood insurance. So the vast majority of the population in the United States does not live near a body of water, certainly a coastal body of water. So the vast majority of the population does not buy flood insurance. It doesn't mean they don't have a risk. Right. Everybody does to a certain extent. You hear about these 100-year floods all the time. But the vast majority of the population does not have a substantial risk of flood insurance. So most people don't buy flood insurance. Well, think about that. What ends up happening? So your pool of buyers now has just shrunk considerably because there's a fairly well-known statistical chance that they are not going to incur a flood. So what ends up happening is you have a very small number of buyers that are coastal that want it or need it, and it's extremely difficult to get it, or at least get it, at an affordable rate, because there's only a handful of people. Those that really have the exposure are the ones that are looking to buy it.
Okay, yeah, so that's good, because I've heard about the flood insurance situation in the United States and never really dug into it to understand what it's about, what's going on. Would that be the same, I would imagine, as things like hurricane insurance, for Florida and so forth? I mean, is there that's limiting who cares in the audience, but still, it's interesting. Is there such a thing as hurricane insurance? I mean, because like in Ohio, where we're based, probably don't care too much about that, like you said, but there's a lot of coastal regions that might.
Absolutely. Yeah. So you're really kind of diving into the weeds of the insurance industry there. So the insurance industry typically does not distinguish specifically to hurricanes. They just refer to it as wind, right? So it's damage caused by wind. And if you look at your own homeowner's insurance policy, you're going to have coverage, especially if you're in Ohio, you're going to have coverage for if your house is damaged by wind, which a lot around here, a lot of people's homes are. It doesn't have to be a tornado, just heavy windstorm that damages the roof or blows siding off someone's house. Absolutely happens fairly frequently, but again, because it affects kind of everyone across the Midwest, as an example, fairly again statistically about the same amount. It's a known. Actuarially, they can determine how likely someone is to experience a wind claim in the Midwest. It's a fairly easy coverage and affordable coverage to get. You start talking about coastal areas like you referenced, absolutely. So what you'll end up seeing is a lot of insurance companies will say, yeah, we provided your homeowner's insurance policy, but we've excluded coverage for wind. So they know that there's a huge risk, way more so on a coastal property for a hurricane, which is i.e. going to cause wind damage, that they'll actually pull that coverage out and make people buy it separately if that's something that they want to insure for, simply because they know that if a hurricane hits Florida, it's likely going to impact a huge number of homes all at the same time. And therefore, they pull that coverage out. They charge a much higher premium in order for someone to buy that coverage back. Because, again, it's when it happens to a huge number of people all at the same time.
And so while we're in the weeds, let me stay here and see if we can give some sort of tactical, potential money-saving advice to people. I got my green tie on for those who are watching, so maybe we'll find some money for people. But this I would imagine would be one of the things that as people are comparing plans, that you really got to dig into the weeds of what you're buying, right? Because I go out and we'll talk later about broker versus internet purchases of insurances and whatnot. But, if I'm just buying house insurance, let's stick with homeowners insurance. Homeowners is not homeowners is, I think, kind of, if I read between the lines, what you're saying. You really need to understand what you're buying. Company A might be cheaper than company B. Hey, we'll save you money or whatever. We won't call out any names today on any issue of companies, but some of them are that cheap insurance vendor. But what are you getting, right? Am I kind of picking up between the lines here what you're saying?
Yeah, 100%. So, that's one of the challenges that we face every day. And I think our industry, in a way has somewhat created this challenge, right? Insurance is extremely complex. And so what most people understand, what most consumers understand is the price that they pay for insurance, which is always a lot. Like, it's just, there's really no way that you look at what it is that you pay for insurance and think, oh, that's a good deal, right? Because most people generally never have a major claim. The interesting thing is whenever somebody does, whenever they call to us and they have a major claim, their house burned down or, tornado wiped it off the face of the earth, they're not calling up and saying, hey, just real quick, before I tell you about my claim, tell me what it is that I paid for my insurance policy. At that point, they don't care what it costs, right? What they care about is it going to fix what it is that they're dealing with.
Right.
So kind of what it is that you're getting at is really the crux of what our industry has kind of done to itself, is that we have commoditized this product in the sense that if you look at all the advertising that exists for the most part, it's the same message over and over again, just, done creatively, depending on who the insurance company is. At the end, it's, switch to us and save X amount of dollars. It's become such a price-driven transaction. And part of that is because that's kind of entering the conversation that's already going on in the minds of consumers. It's, hey, I don't want to have insurance. I know I need it. So let me just go out and find the least expensive thing that I can. The harder conversation for insurance companies and agents or brokers or whoever it is to have is, let's actually dive into the differences between the two products or the three, whatever number of products you're looking at, because it's not a commodity. There are no two insurance policies that are the same. And until you understand what it is that you're actually getting for your premium, you don't know if it's a good value or not. If it's not going to do what it is that you needed to do whenever you need it, then you're right. Like, you've bought an insurance policy, you paid a premium thinking you've got coverage whenever the catastrophic occurs. And then you find out that you don't when it comes time to actually using it. Yeah.
And that's really, I think, my industry is healthcare, and I think healthcare is a whole nother thing in terms of what's going on. You've talked about what your industry has been made into, insurance as a whole. And then I think healthcare is a whole nother animal, because usually the person who benefits from the insurance is not the one paying the bulk of it. These days, people pay more and more of their premiums than ever before, and deductibles and things like that in the healthcare space. But their company, usually, if they're working for an employer that provides healthcare coverage, is paying the majority of the premium dollars. So that's a whole another animal, and we won't necessarily go down that rabbit trail. But it's just, that makes it even harder to pick, and you may not even get the chance to pick.
Mm-hmm. Correct.
So you talked about what, insurance as an industry has become. How did this all get started? Did like one Roman say to another Roman, hey, I'll give you $1 if you give me $5 if, I get, if my cart gets robbed on the way to, Paris or Venice or something like that? How did this all start?
Yeah, it's a really good question. So, and I'm not sure that our industry or history has really definitively determined how it is that got started. So there's really kind of two schools of thought. So if you think about what we talked about initially, kind of what insurance is, it's just a risk transfer mechanism, right? This goes all the way back, I think it was like to the 1600s or even before, where you had traders that were shipping goods, across the ocean. And what they realized is that, if they had everything, like essentially all their eggs in one basket, if that ship hit a major storm, they could lose everything, all at the same time. So what they started doing is they started dividing their goods up that they were shipping across the seas across multiple ships, knowing that, hey, one of them's probably going to get hit, but when it does, I don't lose everything.
Right.
So that's kind of one theory in terms of how it is that really insurance got started. Not what we think of in insurance today, where we're trading, premium dollars for protection, but really just the risk kind of transfer mechanism of insurance. But probably the more commonly recognized, true form of insurance, there was a major fire that occurred in London. I think it was 1666, I want to say. But there were like 30,000 homes that were all destroyed as a result of that fire. And so there was this guy that had a coffee shop. I think it was Edward Lloyd's coffee shop in London. And so this became kind of the meeting place for, those individuals that were looking to figure out a way for how do we protect ourselves from something like this happening again. And still, even in that day, trade was a really big component of what it is that the economy looked like at that time. So what ended up happening, these traders were, amongst themselves working out like, hey, if we all chip in, right? If we all, contribute a little bit into this, kind of pot of money, then if any one of our ships ends up, going down, we're able to be made whole. Mm-hmm. And so that's kind of where the whole really modern fundamental of insurance as we think of it today started. And interestingly, still today, one of the largest, what we kind of call, providers of insurance is what I believe you've heard of, David, is a Lloyd's of London. Yeah. So they still exist today. They're a major player in the insurance market, even right now in 2022.
Which is, crazy when we think about, so that would make them 300-400-year-old essentially insurance company. And I think in the United States, when we think of old companies, we probably think of like General Motors, like 100-year-old companies. So it's fascinating to me to think that this business model in some way, shape, or form is several hundreds of years old, and that some of the original companies are still around. And that makes me just have to wonder. Some people sort of jokingly say that insurance companies sort of rule the world, in part because, we're so litigious. You do something wrong, the lawyers will sue you, and you need insurance to protect, or somebody falls on your property, and they'll sue you, and you need. So does Lloyd's secretly rule the world? Are you part of a secret cabal running things? You were, the insurance advisor of the year in 2019. Were like you running the Ohio branch? What do you think there's any truth to that statement? Half jokingly, half serious. Is it that people just have to make so many decisions around insurance that's where the phrase came from?
Well, yeah, it's an interesting question, right? So if I say no, how can you really believe me? But if it was true, would I really say yes, right? So, but yeah, it's a really good question, right? Because insurance it impacts our lives in so many ways. Like, people think about how much they spend just on insurance. And if you throw everything that every type of insurance that you buy, even if you're an individual consumer and you're buying, homeowners insurance and auto and maybe, an umbrella policy, and you're insuring your jewelry, and you've got health insurance, life insurance, there's just, at the end of the day, if you're doing a true, light item budget, it's a lot of money. As an individual, as a business, it is, right? So, but if you think about how many areas of our life that it impacts, that I think that's where the gist of your question comes from, is that insurance does touch, every part of our life. The even just in the U.S., I think the last statistic that I saw was that the insurance industry is getting upwards of $7 trillion in terms of its total impact, right? So, you could make the argument that insurance companies run the world, but the reality is there are thousands, even just in the U.S., thousands of insurance companies. It's not a monopoly. It's not one or two that are kind of controlling everything behind the scenes. It is a very competitive market still to this day. There's a lot of opportunities for, insurance companies to come in and solve a need that's not being met in the market, or provided at a rate or a premium that's better than what anyone else has been able to figure out how to do, and those opportunities still exist. And sure, there's bad actors just like there will be in any industry. So there are insurance companies that have absolutely taken advantage of their customers and have been called out for it, and rightfully so. But I think overall, as a general industry, just because of the size and scope and the numerous areas that insurance touches in everybody's lives, it's easy to kind of fall into that mentality that insurance companies rule the world.
All right, and as you noted, I see that you didn't directly answer that part of the question because how would we know? It reminds me, I don't know if you ever saw in the 90s, there's a movie called Grosse Pointe Blank with John Cusack, and he's a hitman. He goes back for his 10-year high school reunion. And people say, hey, what have you been doing? And he says, I'm a hitman. And everybody laughs and thinks he's joking. He just tells them the truth, So it just kind of reminded me of that in the moment. But $7 trillion potentially. I mean, we have to validate that statistic or whatever. But $7 trillion in impact is an enormous industry. For reference, I saw the other day that healthcare has grown to $4.5 trillion. So I mean, now I'm sure some of that is probably an overlapping Venn diagram. When people run these stats, some of those healthcare dollars are insurance dollars, and some of those insurance dollars are healthcare dollars. But still, $7 trillion. That's enormous. And so I want to dive into some elements of that, both from if people want to make their career in this space, and we'll talk career stuff. But the other thing I want to talk about is, do you have any idea? Is there even a way to get a handle on how many kinds of insurance there are? I mean, you mentioned some: umbrella, homeowners, healthcare. But I know these days there's emerging that you can get cybersecurity insurance. Earlier we talked about flood insurance. Any idea how many insurance types there are these days, or is it just always growing?
Yes. So you can answer it two ways, right? So the simplistic way to answer it is there's really two. There's two types of policies. They fall into broad categories. Property and casualty, often referred to as P&C. So that's a lot of what it is we've been talking about here so far. So that's insuring your house, your vehicles. If you're a business, your building, your cyber coverage, that falls in that property and casualty category. The other category is life and health. So that's, your health insurance, your life insurance. So really every policy type that exists is going to fall into one of those two categories. But once you get down, kind of drop beneath that, I mean, there are thousands of different types of insurance policies. Whenever, I think about how it is you would actually start to quantify that, it's hard to put a number on it. The easier way to think about it is if there is a financial risk of loss, generally, more than likely, there's an insurance policy to protect that risk of loss. At the end of the day, again, going back to the fundamental of insurance, that's what insurance companies do. They take the risk that we as consumers face, and in return for the premium that we're willing to pay, they take on that risk. So, as I was kind of preparing for this call that we were doing, I pulled some interesting pieces together that I thought you may find somewhat, at least your audience may find somewhat interesting.
I was going to say, do you have a silly example like a pet goldfish policy or something like that?
Three, actually. They're all tied to celebrities, but this just gives you an idea. So, we all think about the types of insurance policies that we buy every day, that we see advertised all the time. But to really kind of hit home at the point that literally anything is insurable. So the celebrity Mariah Carey, right? So obviously known for her vocal abilities. She has her vocal cords insured on a $35 million policy. So if something happens, and I have not actually seen the policy, so I don't know what qualifies as, something happens, but essentially something happens to her vocal cords that makes her unable to perform. She's got a $35 million paycheck coming. Even beyond that. So, and I have no idea how it is the insurance company would price this or why they would even insure it. She insures her legs. She has a $1 billion policy on coverage in case something happens to her legs.
I gotta wonder if that's because I know she's a dancer as well. That's fascinating. Okay.
Yeah. But $1 billion? I mean, 35 million. I mean, 35 million is a big number, but she's obviously known for her singing abilities. But $1 billion of coverage on her legs, like that. So Julia Roberts has her smile insured for $30 million.
Wow. Well,
so you think about what she's known for, right?
She's a multi-million-dollar
glowing smile.
movie star, and Mariah Carey is a multi-million album selling, singer. So the smile and the voice makes sense. The legs, I don't think so. So,
yeah. Well, so I'll give you one third one then that may make a little bit more sense. So everybody knows Taylor Swift. She has same type of coverage on her legs, a $40 million policy. Hers is a little bit more specific, though. Basically, in the event that she can't dance during her performances, because that's obviously a big part of what it is that she's known for. But yeah, $40 million. So it just goes to show, we talk about how many different facets of life that insurance really does impact. And I mean, these are just, a three examples. I mean, there are, and those are really just, celebrities. I mean, there's athletes that have their hands insured if especially in baseball or football. You've got athletes that have their legs, soccer players that have their legs insured. So, I mean, there's just, I really go back to, it's nearly impossible to quantify the different number of different types of insurance policies that exist. But big picture conceptually, if you just think about it from the standpoint of, if there's a financial risk to loss, then chances are there's an insurance policy out there that you can purchase. Doesn't mean it's affordable, but there's an insurance policy that can be purchased to transfer that risk of loss, to an insurance company that's willing to compensate you should that loss occur.
The world, it reminds me a little bit of my universe in healthcare and in the billing and the coding. There's some codes out there people used to make fun of in a system called ICD-10. And this is a system of coding injuries and conditions. And there's some out there for like shark bite and like, I don't know, I fell without a parachute. So there's just some crazy things out there in the world. And as these industries get bigger and bigger, you feel like maybe that more and more crazy bubbles to the top. But a lot of those we talked about for celebrities make sense, assuming they can afford it. So let's talk then a little bit more practical. Yep. Let's get to the ground level inside of that $7 trillion impact and that footprint. I read somewhere or heard somewhere that a large portion of the successful small business owners, in towns, I should say, across the country, Midtown America, are like car dealers, lawyers, tax accountants, and insurance agents or insurance brokers. And so that sounds like a path to entrepreneurship for me. If somebody's a young person or an older person just looking for a different career, that sounds like a good way maybe for them to break in. But counterbalancing that is what you've said about this is such a commoditized industry. So what you're the president of an insurance agency. Do you have advice to, potential future competitors of how to get into this business as either an agent or moving into ownership if somebody wants to own a business? How do you get started?
Yeah, another really good question. It's like a lot of businesses in the sense that it's not the right fit for everyone, right? But your numbers are accurate. And I do know this statistic. I pulled this statistic from our National Association prior to this call. There are 34,000 independent insurance agencies across the United States. So that's not 34,000 individuals like me. That's 34,000 businesses that look like my business across the United States. So yeah, they are everywhere. They're in every small town. And I think to your point, about, being a path to entrepreneurship, absolutely. I mean, at the end of the day, what it is that insurance does for our economy and what it is that I feel like independent agencies do for their clients is extremely noble. I mean, and especially as this movement towards commoditization only grows, I think it makes what it is that we do even that much more important and relevant. Because if we're not there to help advise our clients on why it is that this policy is different from the one that they're considering that may be considerably less expensive, what ends up happening is they buy that less expensive policy, and then when they really need it, it doesn't do what they thought it was going to do. And then the answer is like, well, it's because the insurance industry is trying to take advantage of me. Well, at the end of the day, if you think about it, like every one of these insurance policies that people buy, it's written by an attorney. These are legal documents drafted by an attorney that are essentially saying, here's what we as an insurance company are going to do if you suffer a loss, and what we're not going to do. And then what happens whenever there's a dispute, whenever the client, the consumer, thinks that their policy should do something and it's not, it goes back to then the attorneys to kind of litigate and determine, who's right or who's wrong in that scenario. But my whole contention is, if we as agents, those 34,000 independent agencies across the country, are doing our job for our clients, then we're helping them avoid those pitfalls before they ever even occur. And so your question, is it a path to entrepreneurship? Why would anybody want to do that? The way I look at it is, if you're a lifelong learner, because this industry is extremely complex, it's not one of those that you're just going to come in and you're going to do the same thing day in and day out. So if you're a lifelong learner and you enjoy, being able to help people, this is a fantastic business to get into. I tell everybody that I ever interview, it is a terrible job, but it's an incredible career. If you're looking to build a career, then this is a fantastic industry. But if you're just looking to come in and do the same thing kind of day in and day out, where, you learn the profession in a year or 3 years or whatever amount of time it takes you, and that never changes, and you can just apply that same thing then point forward, it's frustrating. It's not going to be a great, job for that individual. But in terms of how it is you get into it, it's honestly, it's a pretty easy career to get into. We as an industry have done a very poor job of telling our story of getting to the colleges, getting to, the high school graduates and letting them know what this opportunity looks like. So what ends up happening is it ends up being by default. So people end up in the insurance industry kind of by accident. They're maybe in the finance industry because, that's cool and sexy, and they get into that. And then they realize what insurance is. It's like, oh, hey, not a bad path there. They try that. Or the other big way that people get into it is simply by family, which, is exactly where I come from. My father was an insurance agent from the time that I was born. So I grew up seeing what this industry was all about. And I knew kind of firsthand what the opportunities were. So I was excited to get into it. But where we've just done a poor job is we can't rely on that being the perpetuation for this industry long term. It's always going to be family that comes in.
So do you, just to get sort of in the nitty gritty, do individuals need a college degree, or can they get into it with the right, certifications and just rolling up their sleeves and going to work at a local agency or whatever, doing the work? Or do you really need to be college prepared?
For us, and I would say as an industry, I think this holds true. You do not need a college degree to get into insurance because it is so complex and so specific. You get a bachelor's degree from, a great university. Very few of them have anything to do with insurance, right? Most colleges don't offer any courses on insurance. If anything, they may have a course or two on risk management, which just kind of is the tip of the iceberg as far as this industry goes. So nobody really comes out of college fully prepared to go into the insurance industry. It's very much you're learning the product and you're learning the industry when you're in it. So college degree certainly doesn't hurt you at all, but I would say it's absolutely not a prerequisite to get in.
I think that's great. I think that a lot of times when we think of non-college opportunities in America, we think of, certainly I think of, trades, right? You can make a really good life. I mean, Mike Rowe and Dirty Jobs have done a great job of bringing attention to the good lifestyles you can have doing a trade. But this sounds like maybe another opportunity that people could, come in, do good work. If you make enough, you could start your own business, get your right certifications, whatever, and you can be a business owner, a successful business owner, without having had, should you for some reason not want to, go to college and spend that money. I'm not advocating anybody skip college, but just there's more paths out there maybe than sometimes we realize.
You're 100% right. Yep.
Okay, so sticking with kind of this talk about what a broker does then, and we'll acknowledge your bias on this question going in. Do people have to have one, or can I just go out to one of the big, web-based, again, there's many of them, so I won't mention any names, and just buy what I need off the internet? Let me phrase it differently in terms of do people need a broker? What advantages does having an agent bring to the table over just buying it online? Let me ask it that way.
Yeah. So that's a good way to phrase it. My answer may surprise you somewhat here. The agent or the broker does not make sense in all situations. I mean, so I'll give you a really good example. Travel insurance. I mean, that when you talk about it being commoditized, that very much has happened to the travel insurance industry. So there are very few insurance companies left that still provide travel insurance. There's, a handful. Their policies all look pretty much the same. The only people that are buying it are people that have a trip coming up, right? Like, you wouldn't call me out of the blue and say, hey, I'm interested in travel insurance. Oh, where are you going? I don't have anything planned, but it'd be a good idea to have a travel insurance policy, right? So it's a very specific need at a very specific moment in time. And quite frankly, people that are booking their trips, whether that the hotel or, through Expedia or some other online site, they make that available right there at that point of sale, right? Like, do you want to add on the trip insurance? And so something like that, it's likely not going to make a whole lot of sense to have an agency or a broker involved in that transaction. So let's shift gears. So where does it make sense? Or to your question, like, where are the advantages? Well, the way you posed the question was, should I just go online and buy what it is that I need, right? The key point there is what do you need? And do you know what it is that you need, right? So we talked about it before. A homeowner's insurance policy is not the same from one carrier to another, right? And even within the same carrier, they can have hundreds of different combinations of what that policy is going to include. So unless you truly understand what it is that you need and what your exposures are, and then you're able to go out and figure that out on your own, that's where your agency or your broker is going to provide the most value, the most advantage, is to be able to understand what your specific unique needs are, and then be able to go out and source the policy that's going to provide the coverages, the solutions to those needs that you have, and bring that back to you and say, hey, here's what it is that I'm recommending and why.
Okay.
That's the key.
And that makes sense. And then, so any tips on, somebody decides they want to find a local agency, and tips on what to look for. Because I know, as you mentioned, 34,000 across the country. How the heck do I sort through those and pick, separate the wheat from the chaff, as they say?
Yep. Well, the good news is, there's a plethora of tools available, at our disposal nowadays, right? So fairly quickly, you can go online and just look at, what, if any, reviews these agencies have, because generally those reviews are going to be from, their existing clients that are likely, in the same small town that you're looking for an advisor. The other big recommendation that I give people is look to see the number of and the types of insurance companies that independent agency represents. So that's one of the things that we haven't really touched on yet, is just from the agency side of the insurance industry, how things are kind of split up. So I keep referring to an independent agency, which is what we are. So I'll get back to that in a minute. If you take the other side of that coin, it's what the industry refers to as a captive agency. So them better as State Farm or Allstate or some of those types of carriers where they only distribute their product through their own agencies. It's not good, it's not bad, it's just that's the mechanism by which they distribute their product. The challenge is that if you as a consumer, your needs aren't a good fit for that one carrier, there's not a whole lot that agency can do for you. So go back to where we are on the independent agency side. We don't represent any single carrier. We represent a number of different insurance companies. So our whole goal is to put ourselves in the position that whenever our clients come to us and they have a specific need that maybe is a little bit unique, we've got the carrier that can provide the solution to that need. So your question, how do you pick an agency? that's why I say look at the number of insurance companies that they represent and the types of companies they represent. Because the more carriers and the more quality carriers they represent, the better the solution they're likely going to be able to bring to the consumer that's looking for an independent agency.
Good advice for people there. And so I want to talk then a couple areas of, I guess you could call it specific advice, but you've got a generalized audience, so I'm sure that's a challenge for you to give specific advice to a general audience. But I'm also sure, Matt, you're up to the challenge. So I talked in another one of my podcasts with a physician. We talked about end of life planning and medical power of attorney and so forth. And I know that these days there are insurance products that go beyond medical insurance that can help with end of life, long-term care insurance and things like this. Do you feel like, particularly with an aging population, do you feel like we're doing enough there? I mean, do you have a high demand for that? Are people understanding what's available to them to protect them at the end of life? Because I'll tell you, from a healthcare perspective, that's where you just, people retire, and I worry. My parents are headed towards retirement. There's so much expense potential at the end of life. Nursing homes are expensive. They most of them do great work helping people live a quality life for years, but they're just so expensive. So are we doing enough, I guess, broadly speaking, and what specifically can people do to help protect their end of life, their retirement, their, that type of thing as they reach that stage?
Yeah, that's a really good question. I'll take it in kind of two different directions here. Because candidly, no, we're not. We talked earlier about flood insurance and the pitfalls kind of, for the most part, people that live near a body of water are the only ones that are buying health insurance. Long-term care insurance is another really good example of that same challenge, right? You and I likely aren't right now thinking about, hey, you know what? I really need a long-term care insurance policy. It may be 40, 50 years before I need to actually use that policy, but I'm going to buy it today. That's not what happens, right? As an industry, we've not done a good job from an education standpoint. It's extremely costly right now for someone to buy a long-term care policy because the vast majority of people that are buying a long-term care policy see a nursing home in their very near future. So the insurance company's sitting there saying, we know we're going to pay out here within a couple of years. We've got to try to make all that money back that we're anticipating we're going to pay out in a very short period of time. It's the same concept as, somebody gets diagnosed with a terminal illness and then tries to go out and buy $1 million life insurance policy. The insurance company knows they're going to pay out $1 million in the next 3 to 5 years. So the only way to make up for that is to charge, a couple $100,000 for the next couple of years while that person's living. So it doesn't happen. Either, people can't afford it, or, the insurance companies just make it unavailable because of those scenarios. So kind of point number one is, no, we're not doing enough. We need more. We need a bigger pool of people that are buying earlier on, especially for something like long-term care, so that it helps bring down that cost overall. And for those that are going to use it 30, 40 years from now, they spread that cost out by way of a lower premium over a longer period of time. But that's just, that's a tough sell, right? Somebody comes to you right now talking to you about, a $10,000 a year long-term care policy you need. You're like, no, that's $10,000 I could spend on an awfully nice vacation, right? So it's just, this industry needs to do more, both in terms of education and in terms of helping to bring that cost down for consumers. So that's number one. The second piece, though, which is maybe a little bit different that a lot of people don't think about when it comes to, end of life care. Everybody's so focused on, how it is that they protect their estate, at what point in time they've got to make some of these changes to, guard their estate from, nursing home costs that potentially become unmanageable, when they need to get insurance coverage in place to cover the nursing home. What a lot of people don't realize is some of the very fundamental things, and I'll give you a great example, is an umbrella policy. If you don't have the right coverages in place now to protect everything that you've built, right? So the equity that you have in your home, your 401k, your savings account, if you don't have the right coverages in place to protect that, those can become exposed in the event of a claim long before you ever get to end of life care. And so a lot of those assets can end up being depleted, long before you get to that point, which is what, unfortunately, we see, too often. So I talked about that umbrella policy. I'm always fascinated when we talk with new clients and we bring this up. Over 90% of the time, clients have never even heard of what an umbrella policy is. And it's extremely inexpensive. They're usually $150 to $200 a year for $1 million policy. And what it's going to do is it's going to protect them in the event that they end up getting sued. They have a bad auto accident and their auto coverage isn't enough, or, they've have guests over their house and, their dog bites somebody and their homeowner's insurance is not enough to pay that claim. That umbrella policy will kick in. Most people have never heard of it. Like I said, they're very inexpensive, but it's one of those things that you find yourself in that scenario. You have a bad auto accident. Your insurance company says, hey, here's a check for $250,000. That's the limit on your auto policy. We know it's going to be a lot more than that, but that's all we're obligated to pay. So here's your check for $250,000, and it's like, hey, good luck. You're on your own from here on out. That's a really tough situation for consumers to be in, and most of them don't even realize they have that exposure, let alone, what solutions may be out there to help protect against that. So that's why I kind of like to approach this question both ways, because, the health, we'll just call it the health costs are very tangible. They're unknown, like they're kind of staring you in the face. It's some of those other unknowns that most people don't ever think about until something happens.
And that's very good advice for people, and I appreciate that. And you actually brought up a question in my mind. So, given that, as you mentioned, let's say you have something at your house and your homeowners pays out $250,000, and you've got this umbrella policy. Is it a good tactic for people to get the umbrella company from a different company? Because then there's no conflict of interest, right? The umbrella company is going to look at it with a different set of eyes about whether and how much to pay. And not just for the umbrella policy, I guess in general, is it good to spread? I mean, I know you can get like multi discounts and whatever, but should people, we'll go back to some real tactical advice here, should people try to spread this around? Because then you get different companies are going to have different interests in terms of paying, not paying, and having different eyes on it. It's almost like getting a second opinion, from a doctor or whatever. Should people spread that out, do you think?
So let me start the answer to your question by asking a question. So do you remember when we talked about how complex these policies are, and they really are, they vary from one carrier to another, right? So the pitfall or the downside, the challenge that you face when you start spreading these out, I get where you're coming from. Conceptually, that makes a lot of sense. But when you start spreading the policies out, now all of a sudden you're actually creating an incentive for these carriers to kind of fight amongst one another. So you can get one carrier saying, hey, you know what? I don't think this is, I don't owe this claim, but you do. And the other one says, you know what? You're the one that has the umbrella policy. You pay out on this. And so what we end up seeing is that whenever everything's combined with the same company, you're right. Like you get multi-card discounts and multi-policy discounts. So from a pricing standpoint, it tends to be the better route to go. But in addition to that, the carrier knows they're going to be on this claim one way or the other, right? So once the liability coverage is exhausted on the homeowner's policy, the umbrella policy is kicking in. And, when it's all with the same carrier, they know when their homeowner's policy limit's exhausted. There's really no fighting back and forth because they're the ones that are stepping in to provide that next layer of coverage on the umbrella policy. All right.
So that makes sense. It's just essentially avoiding finger pointing is one of the biggest reasons to not do that. Okay. So what is, or is there, and you talked a little bit about an umbrella policy. People don't know what it is. They may not acquire it, but is that, or is there, kind of what's the biggest mistake or omission that people you see make when it comes to insurance, whether that's that umbrella policy, whether that's buying too much, whether that's, because as you alluded to earlier, if you can insure anything, then you could insure essentially everything, and means you could spend your whole budget just insuring yourself. And I don't know that anybody probably wants to live that way with their budget. So what's the one sort of mistake or omission that people make that you see over and over and over again that you would want to tell people don't do that?
Yeah, great question. Pretty simple answer is don't look at your insurance policy as a maintenance type policy. And so what I mean by that is I think people get so dragged down to the details. They want to insure, things like their cell phone, and they want to know, hey, if my power goes out, is the $500 of meat in my refrigerator going to be covered? Like, to your point, we can do that. Like, the coverage exists to be able to do that. Where people, though, I think they fall into a pitfall is they're insuring all of these, what I call property exposures, where there's a known risk of loss. If you've got $500 of food in your freezer and the power goes out, you're out $500. You know that. If you have a really bad auto accident where you injure a family of four in another vehicle, what's the dollar amount on that claim? It's a complete unknown, right? Like, it's going to end up potentially in front of a jury, and a group of your peers is going to determine what it is that you owe. And so what I see is people underinsure on the liability. They underinsure on those areas where they have a complete unknown exposure, and they overinsure on the property areas. So those things that they could pay for, they could absorb themselves, they overinsure there. They drive their cost of insurance up there, and then they don't have enough.
I wonder if neither of us is a trained psychologist, but I wonder if I've read and heard that humans are just really bad with trying to guesstimate the unknown. And so I wonder if that comes back to that psychology of that. It's like, I can see all that food in the freezer. I can see my collection of rare leather-bound books, to go Ron Burgundy. I can't see a negative jury outcome. I can't. I wonder how much that psychology plays into that. And it sounds like often from what you're seeing.
Very, very often. So even when we have that same conversation, because we get that question a lot is, hey, review my policies. What am I missing here? And conceptually, that's what we'll come back with is high level. It's like, your deductible is probably too low. You can afford a higher deductible. That's going to bring your costs down. You're insuring things that you could afford. If this were a loss, you could afford to replace this. Are you really going to turn in a claim, for your cell phone? Well, no, probably not. Well, then why are we paying to insure it, right? But you're right. Like, people can see that it's very tangible. That's an easy kind of concept for people to get through in their mind. I own this, therefore I should insure this. You don't own, a liability, right? So that, first of all, no one ever thinks it's going to happen to them. No one ever thinks they're going to have that really bad claim. And even if they do, they can't wrap their mind around the fact that it could be multi-million dollars. Like, everybody thinks like, I have an accident, I just rear-ended somebody, no big deal. Nobody thinks about, pulling out in front of the motorcycle and, he lays his bike down and he's got permanent injuries for the rest of his life. And so there are things like that those costs add up very quickly. But again, it's really hard for people to conceptualize that. And therefore it's just easier to say, I'm not worried about that. I'm going to insure my cell phone, but I'm not going to insure, for the liability coverage. And that's I'm generalizing massively here, right? Like, most consumers, once we're able to have this conversation, they get there. But to your question, what's the biggest piece of advice? More often than not, whenever we're working with a new client, that's the biggest kind of challenge or hurdle that we have to overcome, is just kind of a shift in that mentality of, this is what it is that your insurance is intended for. Your insurance is intended for those major claims that you're not able to absorb on your own. That's what we should be insuring for. It's not really for the nickel and dime type stuff.
Right. Okay, that's a really interesting perspective. So I appreciate that. And I think it's something that people can use. Again, I think we've hopefully got several items that individuals can use, and if they've stuck with us this far, they can use and take away in their insurance shopping purchases and decisions. So let me zoom out then from the individual. We'll go broad for kind of the final question here. And so forgive me if this is too broad, but I mean, the last couple of years, the globe, we've seen so much volatility, right? Between this nearly unprecedented pandemic and the reaction to the pandemic. and supply chain problems and war in Ukraine and whatever, so much volatility. Is there a role for that $7 trillion footprint to step up, step in somehow, and help the world increase stability that you could see on the macro level? Nobody's going to do this at the individual brokerage, but just that your industry could do. Is there a role there, do you think, or is it beyond your industry to handle?
I don't think it's beyond our industry. I think the mechanism by which it is delivered, that's the challenge. We talked about before, insurance policies are legal contracts. They're written by attorneys. So it's really rare for something to happen as kind of a one-off, right? To be able to say, well, we're going to do this for this client in this claim situation at this moment, because what ends up happening is that you've now set the precedence, right? So you provided coverage or reimbursement or financial relief in this situation, even though it wasn't warranted by the contract, and therefore what ends up happening is it gets opened up to every one of your policyholders that has that policy. So I think insurance companies are inherently risk averse, and that's one of the things that they're going to shy away from. But the interesting point, I think, is how it is that insurance already is playing a huge impact in the stability, right? So just take one example of what we're dealing with right now, in July of 2022. The level of inflation that exists in our economy right now is massive, right? So look at, car prices, whether they're used car prices, new car prices. Like, people are paying $4,000 or $5,000 over sticker on a new car. Like 3 years ago, no one would have fathomed ever paying sticker, let alone above, right? So same thing goes with, homes. Like, it's almost impossible to buy a new house right now. You put your house up for sale and you got offers, in a matter of hours. It's difficult to get, repairs done at your house because the cost of materials is gone up. So if you look at like all these factors, and, another good one near and dear to your heart is, cost of healthcare. I mean, how much has that gone up in the last couple of years? And so you look at all these kind of underlying factors in our economy, and then look at what insurance does, right? Insurance, whenever you damage or total your car, it's going to pay to repair it or replace it. Your home or business is damaged from a windstorm. Insurance is going to come in and pay to repair it or rebuild it if you need to. You injure somebody in an accident, your insurance is paying for their health care costs. And so what you're seeing from a stability standpoint is, if insurance, the way that the policies were constructed, were any different than the way they are right now, we as consumers would be bearing that responsibility 100% on our own. So that inflation that's impacting the used car prices, or new home values, or the cost of labor to get somebody out to your house to fix something, if insurance didn't provide the backstop and the stability that it does, that risk would be 100% borne by us right now. So you would see inflation, in my mind, even substantially higher than what it is right now. But because that risk has been transferred to the insurance industry, by and large, to your point, at a macro level, we actually are seeing stability, even though it doesn't feel like it. We don't see that day in and day out because we're going to the grocery and paying substantially more for the same groceries that we did, a couple months ago. The insurance industry really is helping to stabilize, the economy.
Well,
where we are right
I'm
now
sure
today.
That part of that stabilization is just, I know at this point, when we're recording this, people are talking about recession. This may come out several weeks or maybe even a month or two from now. And so by then we might be in recession fully. I mean, those 34,000 agencies providing jobs and supporting their local economy, that obviously helps. And people need insurance. So I don't know if your industry is one of these that folks call recession proof, but I don't think I'm not an economist. I don't think any industry is truly recession proof, but I know some of them are recession resilient, we'll call it. So, but they're obviously contributing to stabilize in that way by having so many small businesses across the country. So I think what you're saying in terms of the macro impact makes sense, and definitely appreciate your perspective on that in such a volatile time. Well, Matt, I really appreciate your time today. I hope if anybody has stuck with us through the whole topic of insurance here, I hope you've learned some stuff you didn't know, that you've learned some tactics maybe on saving money or shopping for insurance, picking a broker, picking a career. So thank you for sticking with us if you're still out there listening. And Matt, if people like what they heard, they want to talk to you, they want to connect with you, is there an email, a social media? How could people get a hold of you?
Yeah, absolutely. Email is probably going to be the best. Basically connected 24/7 nowadays. So my email is pretty simple: msimon@coverlink.com. And then our website too. I mean, coverlink.com has a ton of information. We try to take some of the most frequently asked questions that we hear over and over again and get that information out on our website. So it's there for, both clients and consumers that are just looking to help get answers to some of their questions, maybe before they ever actually engage, with somebody on the phone or via email. So I would definitely recommend, checking that out if you're just looking to do a little bit of research at this point.
All right. Well, Matt, thank you for joining me on the No Bad Questions podcast.
Happy to do it. Thank you.